Let's assume for the moment that the lower house does decide there are enough people there to want this vote to pass. Is it going to be the package that the markets are looking for? Is it going to unfreeze the credit markets?
It will definitely help, but I doubt that it will be a game changer because it will not stop the root cause of the problem, which is declines in US house prices. Whether it unfreezes the market for interbank lending, which is sort of like a lubricant of the global financial markets, remains to be seen.
Why wouldn't it though? Because you've got all these toxic assets which the Fed would buy, so basically cleaning up the balance sheets of these banks in return for cash. They can then use that cash to lend to banks safe in the knowledge that the banks they're lending to don't have these toxic assets anymore.
It's true that some of those toxic assets will be purchased by the government, but it will be a longer process in 3 stages. We are starting with $250 billion, which is not enough. And depending on the prices the Treasury uses, maybe even the 3/4, if it is fully disbursed, will not be sufficient to remove all of the toxic assets. And even the ones that are not that toxic right now may become so if we are headed for a deeper recession.
Darius, it's Adrian in London. I want to ask you about something that's big talk here today, and that's whether Europe needs some sort of continent-wide action plan similar to the United States to bail out the European banking sector. There's a possibility of a European leaders summit perhaps as early as this weekend. Do you think that Europe does need some kind of coordinated plan of action?
I think that it is important for European governments to provide some support for banks in Europe because they are also facing a lot of losses on their investments in US assets as well as in European assets as the continent is plunging into a recession. Whether this requires a pan-European solution or whether it is possible to do it on a country-by-country basis is a political decision, and I don't think it will matter a lot for the markets.
I just want to come back to what you're saying. Basically, this plan won't work in its entirety. There's not enough money. There's not enough confidence. It's not going to restore enough confidence in the interbank market to get that lending going again, which is what it's designed to do. So where does that leave the US economy?
It leaves it in a recession. This is certain, I'm afraid to say, that there will be, or maybe there already is one.
And the question is then how deep and how long?
Exactly. And this question will be answered by 2 factors. The first is the issue of confidence. Confidence in banks lending money to each other and to businesses and customers, and confidence in depositors, people, us, in our financial institutions. This is a psychological issue, and it's impossible to predict.
But what would be the key thing to turn the psychology around, to get those banks being happy again to lend and get us, or the US depositor, happy to lend again, or to borrow, I should say?
The key issue for depositors will be to trust that none of the major banks will fail and our deposits above the $250,000 are really safe. The key issue for banks will be to see the light at the end of the tunnel in terms of the assets that they already have, all those mortgages that they have extended, and that the Treasury will not buy all of them, all the other loans. If the banks believe that they will not lose further on those, then they will be willing to extend new credit using the cash they will receive from the government. But again, it remains to be seen whether they will or not.